Thank you all for joining. We'll be starting in about 2 minutes. Okay, I think we'll get started with our introduction and then others can join. Thank you very much for joining us for our May analyst call. It's been a few months since our last call, but we are here today with 2 new guests. Thrilled to have a bigger list. So I'm introducing Adam, who is our newest research analyst. He joins us from DL News and formerly The Block. And then Anastasia, who has been at Kaiko for almost 5 years, but is going to introduce some DeFi charts looking at ETFs. So our main focus today of the call is on the Bitcoin halving, of course. So we're going to start with that, but then we have a few other interesting topics that we'll cover right after. So in case you are new here, Kaiko is a crypto data provider. We've been around since 2014, and today we offer several data services. We offer market data, DeFi and blockchain data, analytics. We have compliant rates and indices, our research, and then our data visualization. If you're interested in learning more about Kaiko, don't hesitate to visit our website at kaiko.com, or you can reach out at the end of the call. And some brief updates on Kaiko's side. So we will be at Consensus. If you are attending, feel free to stop by our booth or reach out to schedule a meeting. We also have a brand new data guide. I will send this in the chat, but we created a guide to help businesses and regulators prepare for the upcoming MiCA deadline, which will be this June, and then another deadline in December. So definitely grab a copy of that guide if you in any way need to be MiCA compliant. And finally, a few months ago, we launched Data Plus. This is Kaiko's first data visualization tool. It is free. Anyone can use it. You can access more than 25 unique charts and metrics looking at liquidity, market depth, trade volume, average trade size, a bunch of very unique metrics that is available at dataplus.kaiko.com. So be sure to check it out. It's free. And if you're interested in data and market analysis, it's a great tool to practice your crypto research. So without further ado, let's get this call started. I will have Adam first take the microphone talking about the Bitcoin halving.
Thanks, Clara. And yeah, glad to be here. I guess I'll just go dive in by giving a quick intro on Bitcoin halving and what it is. So the fourth halving took place on, depending where you are, between April 19th and April 20th. The impact on the market was relatively subdued in the first few days after, but that's kind of normal. People typically anticipate the 9 to 12 months after the halving, you'll see sort of a big impact on the market, and we'll get into why that is later. But just for people who might not know, I'm sure everyone does, but the halving itself is just an automated process that happens once every 210,000 blocks, or roughly every 4 years. The first halving cut the issuance, the minor reward, from 50 Bitcoin to 25, and the latest cut it from 6.25 Bitcoin to 3.125. The next halving will happen in about 4 years in 2028. And all previous Bitcoin halvings sort of preceded bull runs. It's kind of, I mean, Bitcoin's up almost, 15,000% in its whole history. So I don't know if 3 is a big enough number to say that, you know, the sample size is there to be conclusive about the halving's impact. So we'll get into some different factors that drive things around that as well. I guess if in efficient markets, the halving should be, the day itself should really be priced in, and everyone should, that information should be reflected in the price. And it's more maybe about sort of external factors like demand and other things that we'll explore a bit more. But just looking at the next slide, we looked at the macro performance of Bitcoin halvings previously. Obviously in 2012, that 8,000% rise in the 12 months after could be a little bit misleading because obviously Bitcoin was less widely traded. And one of the things we like to look at, and we're going to get into in a bit, is liquidity and the impact that can have on prices. So, Bitcoin was far less widely traded, so large orders could have a more significant impact on the market. So really to look at the halvings impact and get a better idea of price. We might not know for a few more halvings, but 2016 and 2020 are probably better to look at what that price action happened there in the sort of 3 to 6 months after. And then a year after in 2020, obviously that 540% increase, there was different factors as well, external macroeconomic factors like COVID, increased money supply, and lower rates. So there was a kind of risk appetite for people who had money to spend, and that might have had an impact. But then on the next slide, we looked at the market performance around halving events. There's not much of a trend really from 3 again, but we can see that the halving initially this year in April kind of ticked higher. The first few days, I think it was outperforming 2012 and 2020. There's been some volatility in the past few days, though. In the past few weeks, the Bitcoin ETFs have started to see outflows, and Anastasia is going to get into more on that in a bit. But there's not much we can infer from this halving so far. It's that market impact, and this just shows what to kind of expect in the first 30 to 60 days. So then the next slide gets into Bitcoin market depth, and this is really looking at liquidity and what we think these two factors are probably going to be more of a driver for Bitcoin's price in the next year. So demand and liquidity and trade volumes will really be the things that support any move higher. And what we like to do with market depth basically is the market's ability to sustain large macro orders without having a big impact on the price. We calculate it by combining the value of buy and sell orders within a 2% price range for a specified period. So we can see that the market depth for Bitcoin sort of dipped there in mid-April leading up to the halving. It's likely due to US tax date. Around then, it recovered a bit and was up after the halving over 400 million, but it's relatively stable and not increasing massively in the last few weeks. And then in the next slide, we look at trade volumes. So volumes spiked on the 19th, over 20 billion, but then they came back down on the weekend of the halving and rose again the following week. This is sort of tracking a trend that we spotted earlier this year. One of our debriefs, we dived into sort of the declining influence of weekend traders in Bitcoin. It's come down a lot in the last 5 years, and it's probably symbolic of the kind of institutionalization of Bitcoin and trading Monday to Friday more often than it is now on weekends. And we've seen that trend continue since the halving. Nothing there has really changed. Volumes have sustained, but the weekend they're falling off. And then the next slide is on miner rewards. So typically the halving has been a bit of a selling event for miners because their reward for mining a new block has been cut in half, and we can see that the reward has come down in 2016, 2020, and so on. It's fallen already now 2 weeks ago. But then if we go on to the next slide, some of that impact was actually mitigated, and it was kind of the most significant event of the weekend, I think, of the halving was this massive rise in average network fees of over $146, I think it was. So it came close to Ethereum's record of $196 for the weekend of the halving. And it was likely forecasted because Casey Rodimer, who launched Ordinals, which kind of brought NFTs to the Bitcoin network in the form of inscriptions on blocks, that had a similar impact when he launched Ordinals. He's behind Runes, which launched following the Bitcoin's fourth halving. So it could be foreseen, but the actual impact was still pretty drastic. And I don't think people saw that's such a significant spike happening. But that spike is that kind of fallen off. So it had mitigated the sort of halving of rewards for miners somewhat. And we can see in the next slide that the higher fees actually help miners. Higher fees were over the miner rewards for a while and sort of mitigated that need for miners to sell potentially and supported them. But the fees have come down well below the miner rewards now, and that could mean that some of these miners are sitting on around, I think, about $5 billion worth of Bitcoin that they might potentially look to sell to offset the cost of lower rewards and higher output for energy consumption for mining since the halving. So that's something that I'll be kind of keeping an eye on in the next few months and how that plays out.
Thank you, Adam. So now it's time to actually highlight some recent trends relative to Bitcoin ETFs since the Bitcoin halving. So quite surprisingly, as we can see on the first chart, the net flows for US Bitcoin ETFs have been near zero, specifically since mid-April and since the Bitcoin halving, after a quarter of positive net flows for US Bitcoin ETFs. And this trend actually suggests that demand for those products has actually dropped relative to earlier this year, where we mostly had very positive and very high net flows, so on-chain Bitcoin net flows for such ETF, excluding Grayscale. And the main reason why we think we have this decrease in net flows for this market is mainly because the demand for BlackRock's Bitcoin ETF is actually slowing down, as we can see in the next chart, which shows again the net flows for Bitcoin ETFs, but specifically for BlackRock's. More specifically, actually, when it comes to BlackRock, they have registered actually their first ever daily outflow of $37 million, interrupting 71 consecutive days of inflows. And they have reached, as you can see on the bottom of the chart, the zero in and even negative territory when it comes to their on-chain net flows for their Bitcoin ETF. However, some good news could actually flip this trend in the coming months, as the fact that major banks as Morgan Stanley are yet to allow their brokers to pitch the spot Bitcoin ETFs to their clients, but we're not there yet. So maybe other news will actually change this trend, but there is no signal yet that this changes tomorrow. Now let's look at Grayscale's Bitcoin ETF, which is still the first in the ranking by assets under management. And what we actually can see here in this chart, which doesn't show the flows, but it actually shows the holdings that back the Bitcoin holdings that back Bitcoin ETFs, is that over the past 4 months, since the SEC has approved all those 11 US Bitcoin ETFs, Bitcoins held on-chain by Grayscale to back GBTC has seen its amount divided by 2. Due to the fact that investors who had taken advantage of the GBTC discount over the past 2 years actually created and continue creating outflows from this trust. And this makes that overall, the amount of Bitcoins backing Grayscale's ETF is dangerously getting closer to BlackRock's, as we can see on the second chart, which shows Clara? Can you switch? Yes. Which shows the on-chain holdings of each of those 2 top Bitcoin ETFs, so Grayscale's and BlackRock's. So we see that the difference between the 2 is barely 30,000 Bitcoins now, out of more than 300,000 Bitcoins for each. And so if BlackRock basically makes it above Grayscale, it will then become the first Bitcoin ETF issuer by Bitcoins under management. However, BlackRock actually has other strategies in store relative to crypto. And in March, they launched a tokenized fund on Ethereum called BIDL for BlackRock USD Institutional Digital Liquidity Fund. And the next chart actually shows the supply of BIDL tokens, because it actually exists as a token, since it's a tokenized money market fund. And I'm going to explain to you what actually has caused this very recent increase in supply for BIDL tokens. But just before, to make sure we're all aligned here on what's BIDL and how to read this chart. So for those that are not aware, BIDL is a tokenized money market fund, which requires a minimum investment of $5 million. So it addresses institutional investors, and in return, the fund commits in investing this money to 100 to U.S. Treasuries, and so the yield taken from this investment is then distributed monthly directly to the wallets that have invested in BUIDL, and it's distributed in terms of newly created and so minted BUIDL tokens. And overall, the value of BUIDL, so the price of BUIDL, works similar to a stablecoin since it aims to track the value of the dollar. Checking now what I just mentioned before, that is what happened lately regarding the significant increase in BUIDL supply, we see that it has increased by almost 80 million BUIDL tokens that have been minted last week. And so this makes that BlackRock's fund, tokenized fund, is actually now the first, even taking the top spot from Franklin Templeton's similar offering. So this trend was largely driven by Underfinance, a real-world asset platform who has actually invested $50 million into BlackRock's fund, and they have announced that in total $95 million of assets will be moved to BlackRock's tokenized fund very soon to allow Ondo to enable instant settlements for its US Treasury-backed token OUSG. Additionally, last week we had other good news that came out relative to BUIDL, and those are related to Circle. So we can move to the next chart. So actually, BlackRock has announced that BUIDL fund holders will now be able to redeem shares for Circle stablecoin, USDC, while before that, investments and redemptions were only done in USD. And actually, Circle is related in many ways with Circle, and not only that way, because actually Circle has seeded BUIDL back on its launch day. They have actually invested 100 million USDC in BUIDL, and we can actually see that this investment has partially driven USDC's total supply that day significantly up. So yeah, this change in supply for USDC is partially due to the BUIDL fund. And lastly, going back to the ETF topic, at the global level now, not only US, but I'm sure you haven't missed that in Hong Kong, 3 mainland Chinese asset managers, namely Bosera, Harvest, and China Asset Management, actually launched Bitcoin and Ethereum spot ETFs. Looking at the data now, we actually have observed that the volumes in USD, like the traded volumes of those ETFs, have been significantly lower at launch day relative to the volumes registered for US ETFs. However, I think that what is good to take from that story is not just the volumes themselves, given the differences in size of markets between Hong Kong markets and US markets. But what's interesting to take from that chart is that the majority of the volume concerned Bitcoin ETFs that attracted more than 77% of the volume at the day of the launch of those ETFs, while ETH ones only attracted 33%, and the days after this trend actually continued with Bitcoin ETFs attracting way more than 77%. So yeah, I would say this trend is the most important thing to remember, like this ratio between the success of Bitcoin ETFs relative to Ethereum ETFs.
Yes, so I'm going to talk a bit about derivative markets. And the first chart I wanted to show is actually the Bitcoin perpetual futures to spot volume ratio, which shows the relative gains of the two markets relative to each other in terms of percentage of volume. So when this volume, this ratio goes down, it means that spot volumes, which are the denominator, are actually rising at a faster pace than derivatives. And what we can see is that for Bitcoin, this ratio has been trending downwards over the past year, ever since Binance removed its zero fee promotion. It essentially means that spot markets have been attracting relatively more volume relative to derivative markets. Looking at this trend from another perspective, this is the next chart. This chart here shows the average spot and derivative volumes for Bitcoin and Ethereum, so it's a slightly broader view of the market. We see that the spot volumes have actually risen above their average level from 2023 and above 2022. They are currently at around 22 billion. And derivative markets have still some catch up to do. They are still below their average level from 2022. The next chart shows Bitcoin open interest and funding rates and what happened before the halving. We see that the market has been showing some clear signs of overheating in the weeks before. We had open interest at all-time high of 17 billion for Bitcoin. Funding rates were also at a multi-year high. And then sentiment changed quite abruptly in April. We had Bitcoin falling in tandem with risk assets, which essentially led to a wave of liquidations, and a lot of this leverage was flushed out of the market. Something very similar happened just before the spot ETFs were approved in January. We had funding rates rising to multi-year highs, and then I don't know if you remember a bearish ETF report, which essentially led to liquidations and a lot of leverage was flushed out. So we actually entered the halving and the proof of spot BTC with a lot less leverage and funding rates at neutral to negative levels. So the next chart actually breaks this down by asset. We have Bitcoin open interest versus Ethereum and altcoin open interest. We see that altcoins have seen, especially high beta altcoins such as meme coins, have seen significant growth in the first quarter. Altcoins open interest actually surpassed Ethereum for a brief period of time in March, for the first time since November of 2021, since the Fed actually turned hawkish. We see also that in the beginning of April, altcoins open interest has declined more because we had significant liquidations. It actually halved to around 6 billion. So a lot of the leveraging already took place. However, the next chart, which also looks at leverage, it shows the open interest to market cap ratio. The higher the ratio, the larger derivative positioning relative to the market cap of an asset. This chart shows the top 30 altcoins, and we see that some pockets of the market, namely meme coins, still exhibit quite high leverage, twice the ratio relative to other altcoins. So yes, the next chart actually looks at options, and historically options volumes have been significantly lower than perpetuals, but we have seen significant increase since October, since volatility came back to the market. It means that more sophisticated traders are entering the market. On average, Bitcoin weekly option volumes has increased to around 8 billion, which is twice what we had in 2023. And also, it's very interesting to look at the breakdown by calls and puts, because last week we had a sort of a shift in sentiment. The share of calls and demand for call options, especially out of the money call options, increased quite significantly, and it is currently at 72%, which is a multi-year high. So with this, I'm leaving the floor to Clara, who's going to talk about stablecoins.
Great, thank you so much. And right now I'm going to talk a bit about stablecoins. It's not really on the halving topic, but I think it's one of the biggest trends of 2024. Stablecoins are, many say, the ultimate crypto use case, and there's been quite a few updates in the stablecoin space over the past few months that I want to share with you today. So the first chart that we are going to look at is going to break down the volume in stablecoin denominated crypto trade volume versus fiat denominated crypto trade volume. This is essentially seeing where are the majority of crypto trades denominated. And we can see here that the vast majority is still denominated with stablecoins. This aggregates all stablecoin trade volume. And that market share has actually increased over the past couple of years, ever since the Terra collapse, which was really one of the lows, to now. Today, about 82% of all crypto trades on exchanges are denominated with a stablecoin as opposed to a fiat currency. So this chart actually breaks down the specific stablecoins and their trade volume so far in 2024. You'll see in orange, these are US regulated stablecoins, but we have two halves to the chart. The first looks at all stablecoins with a market cap greater than 1 billion, and then the other chart looks at a market cap of less than 1 billion. We're broken apart this way purely because Tether has such a high trade volume relative to others, it sort of messes up the axes. So you can see, no surprise here, that Tether is still dominant. There has been more than $3 trillion worth of trades executed for Tether since the year started, which is huge. The second closest is FDUSD, which is a whole other story, which I'll talk about in a bit. And then third is USDC. USDC has had about $509 billion worth of volume since the year started. And then you'll see there's about 10 plus stable coins that have not had as much volume, but are still seeing significant since the year started. But if we look into market share, here's where we see something a bit interesting. You can see that Tether, USDT, which is in dark blue at the top of the chart, has actually seen a drop in market share over the past few years. I think at the end of 2020, Tether's market share was almost 95%. If not more, among its closest stablecoin competitors. And that has fallen quite a bit. Today, it's under 80%. And why is that the case? So a few things have happened ever since. First is that FDUSD, which is a stablecoin that pretty much only trades on Binance, has seen a huge surge in trade volume over the past couple months. This is because Binance is heavily promoting the stablecoin. It lists many zero-fee trading pairs denominated by FDUSD, which incentivizes traders to use the platform and specifically use this stablecoin. So that explains the almost very sudden and massive increase in FDUSD's market share. It's quite mysterious. No one really knows anything about FDUSD. It seems to be issued by an entity with very close relations to Binance. Another reason for Tether's drop has actually been USDC. USDC has had quite a productive year. Its market share has gone from about 1% to more than 10%. This is a big increase. And this was not done because of zero fee trading. It was a very organic and natural increase over time. And so just to be clear, what this chart shows is stablecoin trade volume market share. Doesn't include its actual use in payments. That's a whole other topic, which is something that has not been really closely examined, except this week, actually, Visa just released a report looking at stablecoin usage in payments. And they actually found something which we already suspected for a while, is that the vast majority of stablecoin transactions are done using bots, or in this case, trading. This is no surprise considering most crypto transactions are actually conducted algorithmically. So we already know that stablecoins today are not really used too much in real payments activity, but that could change over the coming months. So I think algorithmic stablecoins have also seen a nice boost in innovation, specifically USDE. USDE, they don't call themselves a stablecoin because they have a unique pegging mechanism to the dollar. I think they call themselves a synthetic dollar. But you can see that that USDE launched earlier this year and saw an initial huge surge in volume, almost hitting $1 billion in daily trade volume, but this has since dropped off. However, just today, USDE, I think, announced its first partnership with a big exchange. This was Bybit. So we'll likely be seeing an increase in USDE's usage within the crypto environment. However, most algorithmic stablecoins actually don't see too much trade volume. And then the last chart I have is looking at USDC. I really believe that we're about to enter an era where USDC is sort of dominating the more regulated side of crypto. It has seen a huge surge in market cap, and trade volumes just hit all-time highs. It's used on quite a few new exchanges, including Bullish and Bybit. And I think that its partnership with Coinbase is going to be very beneficial for USDC. It's getting integrated into the Base ecosystem. And the goal here is really faster payments. So USDC is taking the more regulated approach and really positioning itself as a use case specifically for payments, which is stuff that we do not see in the charts that I've shown. That's just looking at trade volume. So that concludes the presentation. Now you can ask any questions. You can either write it in the chat or use the Q&A tool. But thank you very much for attending. We'll have a recording of this up shortly, and you can also subscribe to our research if you are not already. But thank you very much. We're very happy to be back with our regular monthly analyst call. We'll hold it open for questions for a couple of minutes. Okay, the first question is, how do we source most of this data? So this is all powered by Kaiko. Kaiko is a crypto data provider. So all of the charts you see are Kaiko's data. And if you're interested in our data packages, we're happy to introduce you to a relevant rep. As individual researchers, so we do work with universities. If you're in academic research, we do have a lot of academic discounts. Kaiko, though, today we do not yet offer an individual data subscription plan. However, we do have Data Plus, which is a free data visualization tool, and you can use it for your own research. I'll send the link right now. We have one question about mining shares. Historically, mining shares underperform the months prior to the halving and then outperform in the months after the halving. Do you expect the same to happen again? Do any of you guys want to take this?
I can jump in. I think historically, it's hard to kind of take anything from that. I do know that the last downturn of the last 2 years, we lost a few miners. Some companies couldn't maintain with the market stress, and there was the field's kind of tighter. I suspect there could be maybe some M&A opportunities and things like that, but that's not I'm not inferring any of that from data. That's just kind of anecdotal. So I wouldn't have enough to say really.
I can just add that miners have generally been a way to gain exposure. Sorry, yeah. So I wanted to add that miners have been a way to gain exposure to Bitcoin, and now with the approval of ETFs, you have other ways to gain exposure. So I guess miner shares can also suffer from this increased competition.
You're muted, Clara.
We have another question. Any insights on the recent approval of the HK spot ETFs? Does that imply any change in regulatory attitude from the Chinese government? Desi, do you want to take this one?
Well, I would say that officially the Chinese government has not changed its stance on crypto, but the fact that they got approved in Hong Kong could mean that there is some softening, but officially there has not been a change.
Yeah, and to dive in on that one, those ETFs aren't available currently to anyone in mainland China either. They're only available in Hong Kong, so I don't think it implies much of a change just yet.
However, personally, I do think that this implies some changes on overall APAC regulation on other countries than China, like Korea or even Singapore. So we can maybe expect some changes there in the near future.
Okay, we have one question on, are BUIDL's yields taxable events? I'm not a tax expert. Maybe any of you guys know.
I don't know. I think they pay directly out to the wallet, don't they, in stages? So it depends. If you take it out of the wallet, maybe then you might have create a tax event in that instance. But I wouldn't know enough about US tax law to say.
Me either. Okay. Next question. Are there estimates of miners' capitulation at what Bitcoin prices? So this is, I guess, like at what point do miners sell?
I think that we don't have estimates, but I know that some of the bigger Wall Street banks have said that maybe the price floor for production would be around 42 to 48,000 for Bitcoin in the past, but I'm not sure if we have anything more to add on that.
Okay, any more questions? You can also email us at research@kaiko.com. We're happy to answer anything as well. Okay, we have a couple more. Great presentation. What do you think should be the great obstacle for stables being adopted as a payment method for other goods and services? That's a great question. I mean, it's really about like the vendors that accept these. Like if no vendor accepts stable coins, then they're not going to be widely used. And so I think probably a good strategy for a stablecoin issue is to first maybe partner with more traditional payments providers, and then convince big retail platforms like Amazon to accept stablecoins. And at this point, we'll probably see more usage.
We're seeing a bit of that this year, right? With Stripe have kickstarted their crypto payments plan again, and they're integrating, I think, with Polygon, Solana, and Ethereum. So that could be something that has a big sway on that.
We got a question on how does one apply to join Kaiko? On our website, we have a careers page, and you can see any open careers. One person typing. Okay. Bitcoin rallied following a soft US jobs data. Has Bitcoin become correlated to more traditional financial markets? And what does this mean in terms of using Bitcoin for diversification? Very great question. Maybe I'll let our macro expert, Desi, take a stab at it.
Well, in terms of correlation, I mean, correlation has been declining over the past year, right? And it's still very, very low. It's around 13% with the Nasdaq for the 60-day correlation. But the fact that more TradFi investors are coming into crypto does mean that during periods of market stress, risk asset will move like in the same way. So I guess, yes, probably it is becoming more, but for now, correlation is still very low.
Okay. Thank you. All right. I think that wraps up our call. Thank you very much for attending. We'll be back again in June. And in the meantime, you'll receive our weekly research newsletters. But thank you all.